Well, hello everybody and welcome to this week's episode of Fantastic Female Fridays. My name is Susan Hayes-Cullerton and I'm absolutely delighted to be here to talk to you today about one of my favourite themes of all when it comes to the stock market, namely dividends. So, first of all, for all of you who are new and who haven't met me before, my name is Susan. I'm based in Ireland and I am part of a team at VectorVest and I'm the Managing Director of Europe. So I have the lovely job of taking care of this beautiful continent as well as hosting this show called Fantastic Female Fridays. Now the reason that we set up Fantastic Female Fridays is because I believe that women have got an absolutely huge role to play in the world of investing. And from talking to hundreds of thousands of women all over the world, what my understanding is that many people feel intimidated by the jargon, absolutely want a seat at the table, and really need to build their confidence in order to do so. And that's ultimately what Fantastic Female Fridays is all about. It's dedicated all around women and investing. And of course, men are very, very welcome too. Personally, just to tell you a little bit about me, so I am a CFA, charter holder, which means that I am a Chartered Financial Analyst charter holder. That has been my profession. I have been with VectorVest now for the past 9 years, seen many, many changes, seen many crashes, seen many ups and seen many downs along the way. So that is the environment that you're truly welcome to join me here today at. Whether you came from the Twinterview that we did at Twitter, whether you came from the Facebook Live that we do after every show now, or wherever you came from, you're totally and utterly welcome. So on that note, I am just going to invite you all to please do like the channel, because there's lots of other content that happens here at VectorVest. My own show, Fantastic Female Fridays, as well as Trending Thursdays, as well as a wide variety of other things. So if you like the button, well then of course, if you like the channel, then of course you will be able to at any stage, and then you'll be able to access all of the other content as well. So let's get down to business. Now, what I'm going to do is that I'm going to share a range of slides that I put together. So my slides are over here on this screen. So I'm just going to show you that. Okay, and now I'm just going to go from here. Okay, very good. So first of all, here's what we're going to talk about today. First and foremost is we're going to talk about some basic dividend concepts. Okay, so I'm going to take it from the top so that you can see exactly how this how it's happening here, how dividends happen, what underpins them, and so on. The second thing then that we're going to talk about is that we're going to talk then about why dividends matter. So I'm going to give you some really interesting, in my opinion, some really interesting statistics that are out there around dividends, and that really show you the difference that dividends can make to a portfolio over time. And just before I go on, I'm just going to say hello to everyone who's tuning in here live. Hello to Chief Khan. H1NG says, hello, is there a way to access these streams after the live chat is finished? Absolutely. If you register on vectorvest.com/FFF, you get the link. But of course, also this is live on YouTube, but it will be stored on live on YouTube as well. Hello to Hein Timek, hello to Monica, etc. Keep your comments coming in there. I'm making sure to keep a good eye on the chat. The next thing that we're going to talk about is where do I find dividend information, and then also we're going to look at what do I need to look for in a dividend. And this is where we're particularly going to spend a good piece of focus, because we want to be able to give you practical information that you can take away and implement. That is really what it's all for. Now, the next thing is that we are then going to talk about dividend-focused ETFs as well. So that is going to be, maybe you don't want specifically to look at stocks, but instead maybe you want to look at an ETF. So therefore, I'm going to make sure that you know how to do that as well. Hello to everyone who's tuning in. I see Haley here was tuned in from Hong Kong. It's a late one for you, Haley, certainly, but you're very good for making it. Hello, Kobe. Hello, Shanti. As I say, keep your comments coming in here. All right. Okay, so let's go on now. Let's start from the start, which is what are dividends in the first place. So a dividend is the distribution of some of a company's earnings to a class of its shareholders, as determined by the company's board of directors. So that's what a dividend is. Now, the reason I put euros up there is, of course, is to make sure that you can and will always know that dividends, of course, are paid by are paid out by the company, but they have to be determined by the board. That's the way it always has to happen. So you just so that you're aware that it's not just that the dividends are decided and of course that they keep going. It's more than that. That there has to always be a decision made there on the part of the company to pay them out. So that's how sometimes dividends can be cut. That is also, of course, how sometimes dividends can be increased. It always comes down to the board of directors. Now that's different to bonds. In the case of bonds, there what happens is that you have a scenario where, let's say, a government borrows or a company borrows, and what they have to do is they have to then meet the obligations that they've set out. That's not the case in a dividend. A dividend is a choice that a company makes all the time. Now, in addition to that then, the other thing that's important for you to know about this is that the reason I had started telling you about this, the reason I put up euros here is that a dividend is paid out in a currency, typically the currency of the company where it's headquartered or where it's listed. So if I was to buy, which I did not last week, the week before, I ended up taking on a stock because I sold an option. It closed, a put option, it closed in the money, so therefore I had to take on the stock afterwards. And it was a stock in Amsterdam, a high VST stock as a result of something I had found in the VectorVest database, and as a result then I ended up taking ownership of the stock. Now I'm going to be paid dividends in that currency, which of course is in euro. Okay, so the next thing that I want to tell you is a couple of core concepts that are important to know as we go along is, first of all, the idea of total return. So when we talk about total return, we talk about dividend income and capital gains together. Okay, and I'm just going to quick check over to the chat there. Shanti says hello from Calgary. You're more than welcome, Shanti. Monica said, is this also for people outside of Europe? 100%, Monica. We have a global audience here at Fantastic Female Fridays, and you're all super welcome from wherever you tune in from. So here we have total return, and total return is both the dividend income and the capital gains, right? So again, not every company pays out a dividend. Some companies reinvest all of their profits back into the company again, so they don't pay out a dividend. That can certainly happen. And in that case, of course, if a company doesn't pay out a dividend at all, its total return is its capital gain. But of the stocks that I'm going to take you through today, we're going to focus on where the total return is equal to both dividend income and capital gains. Now, in addition, we can also see here as well that we have the total percentage return. Hi, August from UK. That's great to hear. Then we can see that the total percentage return is the dividend yield and the capital gains yield. So you put the two together. So the same as you might say, okay, my stock might make 2% of a dividend yield, and I'll explain what that is. As well as, let's say, the capital gains yield is I've made 10% of a share price increase as well. So when you put the two together, there you get your total percentage return. When we talk about market value, there you can see the outstanding shares multiplied by the share price. That's market value or market cap or market capitalization. And then dividend yield is the annual dividend per share divided by the share price. So just so that you're aware, just wanted to make sure that you had all of these concepts together and that you understood what they were before we move in to the program later on, but also as we develop into, okay, now that I know what a dividend is, which is a payment paid out of the company's earnings every year, could be once a year, could be twice a year, could be 4 times a year, and I know that dividend income forms part of my total return. When I put the two together, I now know that it makes up then the total return of dividend income and capital gains. Okay, now, so glad that we now know all of these things, and as I say, I'm keeping an eye on the chat there and delighted to hear that there's people tuning in from everywhere. Now, before I go on, I want to give a really big thank you to one person, And that is Hayley, who has been my research assistant throughout the week in helping me get prepared for you today. And she put a lot of effort into looking into a wide variety of research that I'm in a position to present to you. So I'm super grateful to the guys in the US, which are Joey and to Clay, who make the show possible from a logistic point of view. And I'm also really grateful to Hayley in Hong Kong, who has been working with me in research this week as well. So hello Hayley, you're so welcome. Thank you so much for your help during the week. And I just wanted to make sure that everybody knows that behind what you see here, which I'm fortunate that I get the position in front of the camera, there's a team behind us, and it's important that everybody gets thanked for all of their contribution. Now, one of the papers that we looked at in preparation for understanding the depth of impact of dividends is called Why Dividends Matter. And that's going to be in the follow-up email afterwards that everybody gets. So you can, those of you, of course, who are on the mailing list, you'll get that. Anybody else can, just like every other show, you'll get all of the resources afterwards if you're on the mailing list. And again, just to let you know, that's on VectorVest.com/FFF. That is where we just want to make sure we can send all of the resources out to you, and I'll make sure that a link to Why Dividends Matter is absolutely on that email. But this is one of the statements from it, which is, profits are a matter of opinion, dividends are a matter of fact. Now, what does that mean? Well, as somebody that has studied with the background that I have, profits are an interesting concept because, of course, you have sales, you take away costs, then you're left with your earnings. Earnings, another word for earnings is profit. Another slang term for profit is the bottom line. However, there are ways in which to change that profit figure according to assumptions like depreciation. Or there's a range of different earnings per share figures that we could look at. We could look at earnings per share, diluted earnings per share. We could look at operating profit. There's a range of different things. But there's one thing that there is one number for any single time, and that is dividends. So profits are a matter of opinion, but dividends are hard dollars or pounds or sterling that are landed into one's account. Okay? So that's, I just think it's an interesting quote that we can work on, or that we can bear in mind. Now, look at this. I find this number intriguing. This was research done in that paper about the historical return of stocks within the S&P 500 between 1972 and 2010. All right, so, you know, there is 40 years of research in here. Now look, let me just take you through each of the columns. So we have dividend growers and initiators. So they are companies that initiated a dividend in that period of time and thus grew it, right? So either a company that initiated a dividend within that period of time, as well as companies that had dividends beforehand that have continuously increased them. Okay? Then we have second one, which are all dividend paying stocks. So these are all companies that are paying stocks, right? So we don't distinguish here whether they're growing or not. These are all dividend stocks. Then the third column are the dividend payers with no change in dividends, right? So these don't change their dividend rate, no change. Then we have the dividend cutters or eliminators. So these are the companies that choose to either cut or eliminate their dividend. They could do that because they're under pressure in their finances and they say, okay, we can't afford to pay out a dividend. And then on the other hand, they could also be companies where they decide, okay, we're not going to pay out a dividend because we're reinvesting back into the company and growing further. Probably more likely the former though. Then we have non-dividend paying stocks. So these are companies that do not pay a dividend at all. And then on the very right, we have the S&P 500 index. Okay, so this is the historical total return. Remember what total return is? It's both the income and the capital gain element, to put the two together. So here we can see that dividend initiators, growers and initiators, the historical total return of the stocks within the S&P 500 between 72 and 2010 is 9.6%. Then you have the all dividend paying stocks, 8.8%. Dividend payers with no change, 7.4%. Then you have the dividend eliminators or cutters actually suffered a decline in that period of time. Then you also have the non-dividend paying stocks at 1.7%, and that's a really important point. It's really important. So just starkly, if we were just to take the second and the fifth column, let's just look there for a moment. If we were to just look at those two, we can see that the total return, if you just buy companies that don't have any dividend, or you just buy companies that do have a dividend, let's not get into any other detail there. There's a hugely contrasting difference in return. Now, let's also just consider though, of the companies that do pay a dividend, the ones that ultimately end up delivering the greatest total return are the dividend growers and initiators. So what do we want? Well, we want a company that has got a dividend, that has got a sustainable dividend so it doesn't become a cutter or eliminator, and one that's growing. That's what we need. That's what we find, by the way. That's what I'm here to show you today. But rather than just launching in and describing it like that to you, I wanted to show you exactly why I think it's important to talk to you about how all of these things fit in together. Hello, Sandy. Great to have you back here again. Hello. She says hello here from British Columbia. So really, really great. Really great to have you, and thank you indeed for being here. Everyone else as well, whoever's on the show today, please do chat in where you're tuning in from. It's always lovely to see the geography of where people are at. Personally, right now, I'm in Cork, at the south of Ireland. And really, you know, I'm ordinarily in Dublin. That's where I live with my lovely husband, Ardal. But I'm down in Cork at the moment with my parents. And no matter where I'll be, anytime during the show, I'll always tell you where I am. So please do chat in and tell us where you're tuning in from today. Now, the other thing I want to tell you is it's not just about the return of dividends, okay? It also, what's worthwhile considering is actually the dividends as a percentage of the total return. So, as you can see there in the statement I have on the right, in low growth periods, such as the 1940s and 1970s, dividends accounted for over 75% of total returns. 75%. So if you're relying on stocks where, yes, they may have growth potential, yes, they may be reinvesting all of their profits back into the company's growth, which of course may then lead to greater earnings per share, but maybe they don't, because maybe we're in a low growth period at that period of time. Perhaps the company might have better served its investors by simply handing back the cash back to them so that they could use it in whatever way they felt would be a good idea. So instead, in those low growth periods, you would have been much better off being a dividend investor. But of course, there's been other really high growth periods as well, like the 2000s, not including, of course, the end of them, but there certainly have been other periods of time, like the 80s, where there was a significant growth of the commercial sector. And just take a look over here at the figure on the left-hand side. So S&P 500 returns for individual decades since the 40s, and this came from Bloomberg. You can see there, total return in the 1940s, 143%. Total return in the 1990s, the decade that was just the proliferation of derivatives, 432%. The average, not weighted average, not nothing, just the average is 228%. The price appreciation, when you actually break that down and you compare the two, look over there on the right-hand side, that in the 40s, in the low growth period, dividends were 75%. And in the 1990s though, even at a really high growth rate, they were 25%. In the 1950s, which is the highest number on that chart, dividends were they actually represented 45.1%. Now, some of you might be saying, hold on now, dividends can be like 2%, 3%, 4%. How could they work out to be like 75% of your return? Again, all of that we're going to get into. And I will interrogate those numbers and I will show you how it can happen, but just stick with me, okay? Last thing that I want to tell you before we get into what do I need to look for in a dividend is this last chart from the paper, which looks at the ability for dividends to keep up with inflation. Now, quick point. Remember I told you about bonds earlier, all right? So in bonds, the case is that a government borrows, that's called a government bond, company borrows, that's called a corporate bond, or whatever else it might be. But when a company borrows, and we call it a corporate bond, it has to pay a coupon if it chooses to, or else it could be a zero coupon bond. But most of the time, if the term is going to be longer than a year, a corporate bond, we go out to the market and say, okay, we will pay you a 5% coupon on every $100 that we borrow. So therefore, that means that for every $100 that we borrow, we're going to pay out $5 per year. Now, if they stop doing that at any stage, if they don't meet the obligation that they set out to deliver, then that's called default. But a company, on the other hand, it's a choice to pay a dividend every single time. Even if a dividend has been paid for 100 years, and I will show you companies like that, If they choose not to pay a dividend next time round, it's their choice. It's not default. So can you see that there is risk then? There naturally is risk in therefore paying out, well, not paying out a dividend, of course, from a company point of view, but from an investor's point of view, there is risk. There is risk because how do you know if the company itself will pay out a dividend next year? And you are being compensated for that risk in that it does actually keep up with inflation. So if we go back to 1871, let's go back that far, and let's bring it all the way up here, up to 2011. Now, when you're looking at academic papers, it's not like looking at, McKinsey or certainly not VectorVest. All of these papers have to be peer reviewed, and that's what gives them their substance. So it's not that this paper is out of date. It just it has an awful lot of data, and it takes quite a while to put that together. But as you can see there, the inflation potential is actually a really good example of how the increase in the dividend also equals the rolling 10-year growth in inflation as well. So there is great, what we would call inflation hedging power in dividends also. So the thing is that we are going to now take a look at what I need to look for in a dividend. But before we do that, what I want to talk to you about is where do I find the dividend information itself. So what I'm going to do now is I'm going to switch screen. Okay, so I'm going to bring you over here to my other screen. Let me just change that around here. Okay, very good. So let me bring you over here, and I am now going to Google. Okay, somebody is from VectorVest is telling me that they're welcoming me back, which is lovely. Now, okay, let me just let me go over here, and what I'm going to do here is I'm just going to go to google.com, right? Now, for a start, let's say that I'm starting from the very, very beginning, right? From the absolute very, very beginning. Now, what I would like is I'm going to take a company like Colgate, right? Colgate, and the reason that I picked this company is I bought and sold Colgate many times because of its dividend, so I'm particularly familiar with it, but this will work for whatever company you want to look at. Here's how I find the information. So I go to Colgate and I simply put in either dividend history or investor relations. You can tell there, you can clearly tell from my screen here that I have done this many times before. So if I click on Colgate dividend history and I particularly go down to the investor relations here in Colgate, you'll notice that right in here, there we go, there is all of the dividends all the way back. And the reason in particular I wanted to show you this one is Colgate Palmolive has paid uninterrupted dividends on its common stock since 1895. Remember I told you that I would tell you of a company that has been paying dividends with over 100 years? Well, there you go. There you go indeed, is that they have been paying since 1895, and particularly they have been increasing payments to common shareholders every year for the past 57 years. Now, is that a good dividend? I don't know yet. Well, I do, right? I personally do, but that's because I've researched this. But I'm going to take you through the path of trying to understand whether it is in a good scenario, or how to determine if the fact that it's been uninterrupted, good. The fact that it's had dividends for over 100 years, great. But how do we know that it's a good dividend to pursue today? Well, that's what I am going to teach you. But that's how you do it, okay? You search for, let me take actually, does anyone have a stock there that they want me to check out? Let's take a look at its dividend history. You take a look there in the chat, let's see what's going on. Okay, so Jeff is here from Detroit, Betsy from Maryland, Tarek from Dallas in Texas. See here somebody from Lancashire, Haley's from Hong Kong, Ardlis, hello in Dublin, Joost is here from Amsterdam. See another person here from Dallas, great indeed. So yep, keep the comments coming. So I'm going to say maybe Walmart. Okay, if I put in Walmart, and I'm going to say dividend history. Let's see if this brings it up. So if I look here at dividend history, you can see stock.walmart.com, and right here then I'm going to see the dividend history. So it's really, really simple, like really simple to do that. So then Shanti says Kiera, please. Okay, let's take a look at that one. K-E-Y-E-R-A, dividend history. Hello, Weety comes from Miami, Florida, gorgeous part of the world as well. I've nearly been to everyone that's on here today. Everywhere you've mentioned to me, I've nearly been to all of those places. So delighted to hear that. not dividend payout, dividend history. Okay. And I'm going to, yeah, there we go. I generally tend to go and look at the actual stock website itself if I want to see this. Now, of course, I'm going to give you an even simpler way to do all this, but yeah, there we go. You can see all of that there. Very, very simple to do, right? Very, very simple to do. But the question is, when it comes to actually picking a dividend, when it comes to determining if the dividend is a good one or a solid one, what do we do? And that is where I want to show you 3 key things that you might consider looking at. Okay, so here they are: dividend yield, dividend safety, dividend growth. Okay, dividend yield, dividend safety, and dividend growth. They are the 3 key things that we want to be able to figure out. We want to see, what is the dividend? Is the dividend giving me a substantial return on my investment? My investment being the money I'm going to put into the share. Secondly, is it safe? And thirdly, is it growing? Okay, now of course I could manually work out all of these things, right? And manually I could work this out by saying, okay, dividend yield is dividend per share divided by the share price. I could say dividend safety. Well, how I figure that out is I'm going to look at the earnings per share, how much is the company earning, versus how much is it paying out in dividends. In other words, is the earnings per share greater than the dividends per share? And the growth, well, I could look into the history and I could extrapolate out forward. But I'm going to do a much simpler version of that for you today, okay? So what I'm going to do today is I'm going to show you how to use the VectorVest system in order to elucidate this information. But I'm also going to show you what happens behind the scenes so that you can figure out a way that you can get this information yourself. Now, it will take longer. And of course, you also need to make sure that you're operating with good data that is accurate and so on. But that's what I'm going to do. I'm going to show you, first of all, how to get it and come up with the information. And then secondly, what I'm going to do is then tell you how to interpret it, because that is really what's important. Okay, so what we're going to do is let's switch over now to the program. Let me just go back over here now. I'm going to open up the program. And error has, okay, well, I want that to go ahead. And let me go over here to the viewer. Okay, now just checking here on my screen that it's easy for everyone to see that. Yeah, I think it is. Great stuff. Right, now I'm going to click here on stock viewer. And in here, I am going to look up a stock and I'm going to look at particularly its dividends, okay? Now, if at any stage, if anybody wants to pop in a stock, we can take a look at that. That is absolutely what we're here to do. So feel free to pop one in. Glenn Tompkins recommended you. I'm really delighted to hear that. Well, Michael says, I love good information. Well, you're in the right spot. You're all in the right spot indeed if you want to hear just how dividends work. So, I'm going to take, okay, I've already spoken about Colgate. I've already spoken about Walmart. What else might we take a look at? Let's take a look at Coca-Cola. Okay, Coca-Cola, right. So here, I'm going to take a look at Coca-Cola. Now, another stock, this one I came across in the Hot Stocks panel, is a stock that Steve Chappell actually spoke about. And in that case, Steve Chappell spoke about Dollar General, for example. Now, another one that I was talking about during that, and you can get that if you search again, if you search on YouTube, you're gonna find this the Hot Stocks panel that Steve and Glenn, that one in particular as well is that for Wheatie there. That's Glenn was on that Hot Stocks panel as well. So another one that I spoke about that day was Apogee. Okay, so right, okay, so here we go. Dollar General, as you can see here, it's got a buy recommendation. Apogee, it's got a buy recommendation. Okay, Colgate is a hold. None of this is to do with our dividends yet. Now I'm just going to see what else. Now Michael says Expedia. Okay, let me see if we have that Expedia. Yeah, there we go. We have Expedia in there as well, and let's add those in there. Okay, now let's take Dollar General. And let's take Apogee, Expedia, and Coca-Cola for the moment. If I want to look up just quickly the dividend yield over here, you can see over here, I can see that the dividend yield is, let's say in Dollar General's case, it's 0.65%. Apogee, this is the reason that I picked the stock, by the way. One of the key reasons I picked the stock and put it forward in that hot stocks panel was the dividend yield. I thought was really, you know, it was quite high. And I'll give you the context for why I think it was quite high in a moment. Then we see Expedia over here, Michael. It actually doesn't have a dividend, it seems. Doesn't have a dividend at all. And then Coca-Cola. It's another one, again, I'm quite familiar with some of these stocks where they would be pretty well known for their dividends. So what is a dividend yield? Well, what it is it's the dividend per share divided by the share price. And this was one of the concepts that I put up right at the beginning of the show. But let's say that I wasn't aware of that and I would like to know more about it. Is I can right click, view full stock analysis report. And now the full stock analysis report has actually appeared on my other screen. So there we go. Now, if I scroll on down here, scroll down, 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 and here we go. See in here? See we have the dividend. So the actual amount of dividends here, which is $1.44 per share. And then we also have the dividend yield, which is the dividend per share as a percentage of the share price. Now, can I ask the team at VectorVest, can I ask you to do two things, please? Number one is, can I ask you to please share the link to the hot stocks panel that Glenn and Steve Chappell and I participated in a couple of weeks ago? And the second thing is, can I also just ask the team at VectorVest, could you please share the free stock analysis report link? Because if anybody doesn't have the system, I want them to be able to follow along with what we're doing tonight, and they can basically use that to get a stock analysis report like I have here. And then of course they can also take a look at all the dividend information and the others. So just reach out there to my colleagues in VectorVest, the hot stocks panel YouTube link, as well as the free stock analysis link. Thanks a million, guys. Okay, that'll be there now shortly. So Monica's a question, silly question. No such thing, Monica, I promise. They're always welcome here. But would that mean the dividend yield fluctuates constantly since it's based on the share price? Absolutely, yes. The dividend might stay the same. When the dividend is announced, then that stays the same, but the share price changes all the time. So you can see here, Monica, my prices are live. My prices here, my Dollar General prices, they're live. They'll constantly change there throughout. When we look back on this again now a little bit later on, you'll also see that will have changed, like you've just seen there, and therefore that is then reflected over here in the dividend yield. So yes, it does fluctuate constantly. Hello John, tuning in from Montreal, really welcome. Loving all the people from Canada tuning in today, it's great. Love it. Oh, now, all right. So if I just open back up there my stock analysis report there again. So that's the first thing is the dividend yield. Now, here is how you can get one way of measuring if a dividend yield is solid. And that is the average for all stocks in VectorVest. So look up here. Now it's hard to see there, so I'm going to read out the number for you. We have 8,372 stocks in the US database. In the European database, we've around 2,000. So when you take the average dividend yield of all the stocks in the VectorVest database, you get a good sense of the market. You do. Now, of course, all of those stocks that have a 0% dividend yield are all given the same weight as those companies that have a dividend. So that's why the average is so low, but it's also reflective. So here in the case of Dollar General, we have that it's 0.65%, and this is below the current average of 1.05% for all stocks in the VectorVest database. Now, personally, that's why, as I say, when I did that hot stocks panel, I chose Apogee because I specifically went out of my way to find a stock with a high dividend yield. So you can imagine if I right click here, which I will, bring up the full stock analysis report here, which I have done. Okay, and now I had a bad day of the races yesterday, but that's okay. And we come down here, right here, DY, you can see here it has a dividend yield of 3.11%, which is actually 3 times higher than the current average of 1.05%. So that's one way in which to compare. You can look at the average of the VectorVest database. Let me show you another way. Now I'm gonna need you to work with me here and visualize. So look here at Apogee's dividend yield, 3.11%, right? So I know I understand it. Some of these can be difficult to read. You know what I can do now? Let me sort that out for you. Let me sort that out for you right now. And all I need to do is I need to change the font. Oh, okay. Yeah, all right, I'll just close that now. And my mouse has got lost. Okay. No. Just try to get that back because that isn't working for me. Okay, well, that's all right. I'll just close it down here. All right, I'm not going to be able to do it right away here, but anyway, I'll read out the numbers for you instead. So here, where we have that the dividend yield is 3.11, what I want you to do now is follow me all the way down to the bottom of the screen. Now, I'm in the way, so I'm going to have to get me out of the way here first. Okay, let me just move me out of the way. Okay, I'm just going to move me up here. And now look at the difference here. Look at the dividend yield. Okay, so the dividend yield here is 3.11. Come right down, right down, right down, right down, right down. And look what the dividend yield is of the industry. 0.73. So actually, it's not that just a bogey. Now, by the way, it's a company based in Minnesota. If I'm not pronouncing it correctly, apologies. But this is what I think the name of it is anyway. As you can see, it's also significantly higher than the index, than its own industry as well. So that's the second way that you can determine that. The third way is more economic, and that is that, remember what I told you about a risk, okay? If I buy a government bond, the government has to pay me its interest according to what it had agreed to do, even if that interest has to be paid for a 20-year maturity. But in the case of a stock, a company can literally, it can stop paying a dividend right away. Well, then the other way to look at this is to say, how well am I being compensated in order to take that risk? And one way that you could look at it is, well, how does that dividend yield compare, let's say, to the risk-free rate like cash on deposit or government bonds at the moment, etc. That is the other way that you could look at this as well. Okay, so that's the way in which you can make decisions around the whether a dividend yield is actually good. Is look at its own history, look at it in comparison to the industry, or you can also examine the risk premium in comparison as well. The second thing though is it sustainable? Now, when we think about this, let me talk to you about this now. I'm just going to pull back on my camera here. Let's just have a chat here now. Let's have a chat here. You and me, let's have a chat about this. So, dividend safety, or the solidity or the stability of a dividend, it comes down to one thing, right? Now, I spoke about this over and over and over again at the summit that we held at VectorVest a month ago. And I said the same thing over and over, which is the company earning more than it's paying me? Is the company earning more than it's paying me? Is the company earning more than it is paying me? So the question that I ask you to consider is, what is the earnings per share of the company relative to the dividend per share? And of course, if the company is paying out more in dividends than it's earning, that's not a sustainable dividend. And then of course, I could just almost feel it coming in the chat if it's not there already, which is, how much more than the dividend per share should the company actually be earning? And it's kind of hard to answer that question. You could say, well, you know, if the company is earning twice the dividend, well, then that's a good thing. Yes, it is in some cases, but in some companies, the margins simply wouldn't be there to enable that. And then there's other companies that give away most of their dividends, not because they're unsustainable, but because they're in a defensive sector where they produce profits year over year after year after year, and they're in environments where if the economy goes up, well, then they're not going to make a whole lot more money. But similarly, on the way down, they're not going to lose a whole lot either. For example, there's the light on over my head here. There's a light on in front of me here. Do you think that if we went into a severe recession, I wouldn't have the light on right now for this show? But similarly, imagine if economic growth rocketed. Do you think I'd turn on an extra light just because I could? That's what a defensive sector is. Cyclical sector is different. That is where it might be luxury. That's where it might be holidays. Well, the ones we can take at the moment anyway. That's where it might be cars. That's where in the event of a recession, the expenditure on those goes down, but in the event of economic growth, it goes up. That's a cyclical industry. Whereas there's some companies that are very defensive. They have rock steady Eddie type of earnings, and they give out most of the earnings every year in dividends. So it's not due to unsustainability. So it's a hard question to answer. However, I of course do have an answer for you at the same time, and that is that rather than just look at comparing dividend per share to earnings per share, VectorVest came up with its own dividend safety metric. Okay, so let me just pop back over and I'll show you what that is. So DS over here, I'm going to put back up the stock analysis report. There we go. Now here, okay, now look here at the dividend safety here of Apogee. Dividend safety is an indicator of the assurance that regular cash dividends will be declared and paid at current or higher rates for the foreseeable future. Dividend DG, sorry, this is Dollar General here that I'm looking at, sorry. Dollar General has a dividend safety here of 97, which now that is, when they say excellent, that is really, really excellent, okay? So that is excellent on a scale of 0 to 99. So that means that rather than saying, okay, how do we compare earnings per share to dividend per share? I know earnings per share should be higher because is the company earning more than it's paying me, but how much higher? So that's what VectorVest is taking care of here in its dividend safety metric. So whatever stock you want to look at, if you're not a subscriber, go into the free stock analysis and download your report, and you'll be able to find it out there for sure. By the way, thanks so much indeed to the guys at VectorVest. They've put up that. You can have the link there to the free stock analysis report. You can use up to 3 today, and you can also have up to 9 overall, right? So there's lots of scope in there. Thanks a million as well for mentioning there that we also have the hot stocks replay. Really, that's brilliant. Now somebody else says, how can we follow you to trade in the Indian stock market? What I would say there is, for a start, I would like the channel, so then you get access to all of the VectorVest content that happens, and also any of the Indian ADRs that trade in the US market. You can certainly use the product for there. Matthew says, how can you tell a company's debt from VectorVest fundamentals? Now, Matthew, it's actually woven into some of them, particularly relative safety. That's where you look at the debt to equity ratio. So that is where it can be as well. Bill says, I'm sorry, your voice will be much clearer with a headset or a desk mic. That's what I have right here, Bill. I hope that's okay. Okay, so now I'm going to go back over now and let's take a look at any stock that I might be interested in and how does that compare. So if I go back over here to, let's say, Dollar General, so we know that its dividend safety is right up there at DS of 97. If you come down, you can see here the average dividend safety. Oh, can you see there? No, I'm still in the way. So let me bring it over here again. So up there we have Dollar General. Its dividend safety is 97. But if you come down here, you can see that the dividend safety is actually 26. So that is much lower, much lower than the industry. Okay, the industry is much lower than the stock. Sorry. So a big difference there. Okay, so that is how we look for solid. That is how we look for sustainable, but we also want growing. We also want a growing dividend as well. Now, can you imagine what we think, or what you think we call dividend growth? Exactly, we call it dividend growth. So if I bring back up, I'm going to bring back up here my stock analysis report here. And if we scroll out down there now to DG, right? So DG is Dollar General. So we also look at DG here in terms of dividend growth rate. So dividend growth is a forecasted annual growth rate of a company's dividend based on historical dividend payments and dividend predictability. So I can go into Colgate's website and you'll find the information. You can look back and, like, I can tell you at the quarter, Q4 of every year, for the past 57 years, Colgate has increased its dividend, and I could nearly predict myself what it will be next year. Of course, you can go back and do that, and that is here what a quick look into this can be done as well. So dividend growth rate is the forecasted annual growth rate of a company's dividend based on historical dividend payments and dividend predictability. It is a subtle yet important indicator of a company's financial performance, and it also provides some insight into the board's outlook on the company's ability to increase earnings. After all, why would you increase the dividend if you didn't think you could increase the amount of money that you're earning to substantiate the dividend as well? So as you can see here, DG, which is Dollar General, has a dividend growth rate of 15%, and this is above the current average of 6% for all stocks in the VectorVest database. So here we can look at its own history. We can look at it here, like the growth rate of 15% is very, very significant. Or I can also look down here again at the bottom of my screen and say on average in the industry, the dividend growth rate is 4%. So that too is a very, very high level. Okay, so that is what dividend safety, dividend yield, and dividend growth are all about. Dividend yield, again, you can calculate this as dividend per share divided by the share price. Secondly, dividend safety is where you look at the earnings per share in comparison to the dividend per share. Is the company earning more than it's paying me? Okay, so that's what that is. And then dividend growth is its predictability into the future. Now, let's say that you want everything. You want the combination of everything, right? Let's go and put that to the test. So what I'm going to do is I'm going to go over here to Unisearch. I'm going to show you two ways of doing this. Over here on the left-hand side, we can simply find some interesting searches that already have dividends in them. Okay, so we can take a look here at the prudent searches, or we can also take a look at the conservative searches. And in here, for example, we have dividend payers, we have dividend plays, we have discounted dividend payers, for example, right? There's a range of things in there. So if you just want to go straight in and you just want, okay, I want to find a pre-built search that will just simply find high dividend yielding stocks that are growing and that are safe for me. You can do it that way. But let's go the harder way, right? Let's do it ourselves. So what I'm going to do here is I'm going to create a new search and I'm going to look for, I'm going to pull up the chat here. Tell me what sort of a dividend yield you want me to look for. Suresh says AEP, I'm not, okay. Shanti says, is it good to buy a company stock which is paying a dividend or plugging the money into their growth? You see, Shanti, this is the thing. This is the thing, is that you do need to consider that, and maybe it's company specific, but remember the figures that I showed you at the beginning, looking back over history. When you think about that, it does point out the fact that when you look at non-dividend paying stocks and you look at dividend paying stocks that have got that have initiated and are growing, then there can be quite a significant outcome. So, but of course, it all does come down to the company. It comes down to the investing approach that you might have rather than speculating. It comes down to market timing. It comes down to a range of things. But personally, I'm somebody that always looks for a dividend. Rarely I don't. Okay, so RD says hello from India. That's great. Glad to see that you're tuning in today. So what I'm going to change the parameter. I am going to look for a dividend yield greater than, let's say, 3%. Okay, so that's what I want first. This is what I want. Secondly, I want the dividend safety to be greater than, let's say, at least 50. Okay, at least 50. And the last thing I want is that I want the dividend growth rate. So the average is 6%. I would like this to be higher. I'm looking for the dividend growth rate to be above 10%. Of course, I wouldn't just be happy with average, would we? Okay, and let's run the search. How easy is it going to be to find stocks that look at that? So we simply don't seem to have any problem at all. So we have Big Five sporting goods. I'm going to come back to this. Advisor shares, YOLO, an interesting acronym. Global X Canna, with the cannabis ETF, AbbVie, many of you might be familiar with that. Pharmaceutical stock, Unitedcom, Southwest Gas, Glacier BNCP, iShares MSCI SA. I think that's South Africa. But you know what? I don't have to think. All I need to do is pull up the free stock analysis report. Yeah, and I was right. I was right indeed. So this is exactly what it is that it is the iShares, the ETF actually in South Africa. Let's just take a look, see what the dividend yield is. DY is actually, the dividend yield is 3.32%. Yeah, and dividend safety of 58. and growth rate of 11%. Okay, so you can see how all of that works. So I can also go and I can do that. I can put those things together, and that's how a screener works. Or, of course, we have an even simpler solution as well for you, and that is, let me bring you back over here to the viewer. Let me show you this, which is you actually don't need to look for dividend safety and dividend growth and dividend yield all individually every time. We have YSG. So YSG is the yield, safety and growth indicator, brings all three together. And then that's it. That's how it works. That is how you can look at all three together. So as I say, you can go and you can do the research. Absolutely, of course you can. But if we go back to where we started this evening, this afternoon, this morning, tonight, wherever you're tuning in from, what we did is that we said, right, fundamentally, what a dividend is a payment out of profit from a company to its shareholders. Secondly, what we want to know though is, does it matter if we invest in dividends? And that's where I took you through those figures. And over time, it certainly does. And here's where I just want to put a marker to just remind you of one important point. Okay, so let me just go back here and have a chat with you about this. That is that if I buy a stock today, and I want to go back to Monica's question about the change in the share price and thus the change in the dividend yield. If I buy a stock today, going to pay $100 for a stock today. Dividend is $3 a year. Dividend yield then is 3%. Now that share then, it goes up, okay? Share price goes up, okay? It doesn't matter what it goes up to, but then the dividend also goes up. So the dividend then goes up to $3.50. Now, while the dividend yield might change, of course it'll change in the future, depending on what the share price was, my dividend yield is now 3.5%. My dividend yield. That's because I bought it at $100. Now the dividend went up to $3.50. Next year, the dividend goes up to $3.75. My personal dividend yield. You're not going to see that in VectorVest. You're not going to see that on Google Finance. You're not going to see it anywhere because the share price that I bought at is only the price that's in my portfolio. So therefore, let's jump forward 10 years. The dividend has now gone up to $10 a year, let's just say. Then my dividend yield is 10% a year. So you can see when you actually accumulate dividends over time, particularly if the share price rises, and of course if the dividend rises, that's why it's important that we look for high yield and high safety and high growth. They can really accumulate, but that's not all. The other thing is, how about if I take all those dividends and I reinvest them back in? And that is, I have to say, I do it all the time. I make sure that, you know, when we do get dividends, we put them, if we've sold something, we'll close, we'll take what the amount that we sold. So we'll take the capital that's there and put the dividends in and then reinvest it back, sometimes into the same stock, sometimes not. But that's also where the power of compounding comes from. So two places is if you buy a share and then as time goes on, the dividend per share goes up. But of course, the price that you bought at stays the same. The price you bought at, the price that you're going to sell at, of course, that changes according to whatever it is. But the price that you actually bought the share for, that goes into your account, as in onto your statement. And then the second thing is, as those dividends are paid out, as you kind of, you know, like a snowball, put them back into your portfolio, that can really make a difference. Okay? Now, then we went on and we said, where do we get this information? So look, really simply, you can pop onto the system and you'll get it there. For any of you who are subscribers, for those of you who aren't, you get a free stock analysis report. You can get up to 9 of them. So use those and you can see exactly any dividend related information you might be interested in. And then of course, the third thing is you can simply do the research yourself. Google dividend history of a company or Google investor relations. Then we went in and there were 3 key comments that I said is that yield, look at that in comparison to maybe non-risk assets like cash deposits or a government bond yield that's safe, or you can compare it to its own history, or you could compare it to the industry or the average of the VectorVest database. That's how you determine if a dividend is good, if it's good or if it's solid. Then you need to make sure that it's safe and sustainable, at least sustainable anyway. And the question to ask is the company earning more than it's paying me? And that's how you compare dividends per share to earnings per share, particularly the dividend safety ratio, dividend safety rating is a good one to look at there. And we looked at the Dollar General example to see an example of something that's really high. And then growth. Growth depends on the path of the dividend in the past, as well as the predictability in the future. But remember, if a company is intending to pay out a higher dividend next year, then it is also likely that it is intending to earn more next year as well. So it gives an insight into the board's view on profitability. So then what we did was then we said, okay, if I want to search for all of the combinations put together, I can individually look for those things and I can put together a screen like I did in Unisearch, or you could look at something like the YSG indicator as well. And I could just go onto my viewer here and I could look at like the top YSG stocks in the database. But I am aware of time and I'm super respectful towards your time, and that is why I want to deliver upon the last part of what I promised we would do today, which is looking at dividend yielding ETFs. Okay, so let me just pop back over there. Monica says, makes sense. Delighted to hear that, Monica. Delighted to hear that indeed. Great stuff. Okay, so let me pop back over here, and if I wanted to look for, I can do this one of two ways. I'm familiar with a number of high dividend yielding ETFs, so we can look at those, or we could also go back to my Unisearch here. And if I look at some of these, I'm just looking here at ones that look like they could be ETFs. Now, I'm sure the cannabis ETF is an ETF because it says it's an ETF. Anywhere that has iShares in front of it is probably run by iShares. When I saw SA, that's why I thought about South Africa. But neither of those cases now would they be specifically ETFs that are looking for dividends, that are looking for high dividends all the time. So what I'm going to do is I'm going to bring you to one that particularly does, right? So I'm going to bring over here to the viewer, and this time I'm going to put in DVY. And this is, just going to wait now until this comes up. Okay, here we go. And let me take a look here at this. Let me just, very good. Dividend, look at the dividend, look at this. Look at that dividend yield. 4.18%, a dividend yield of 4.18%. Higher than anything I've shown you, higher than anything that I've shown you. So let's take a look at this one. We can see here that the RT, anybody that's not familiar with RT, that's relative timing. That tells us whether the stock is moving up, down, or sideways. But also, it's also telling us about the volatility, the dynamics, the magnitude of that. So is it moving up strongly, and is it moving up in a really volatile way? So 1.11, that's telling me, I haven't looked at the graph, but that's telling me that the stock is moving up, and it's moving up with some force, but probably not hugely volatile. That's what that's telling me. But what I'm really interested in doing here is, I want to show you how to analyze that though, okay? First of all, of course, no one's going to be surprised at me doing this. I get the stock analysis report. Sorry, it's an obvious point, but I should say it anyway. Anybody that does have the system, you can get as many stock analysis reports on as many days as you possibly want. Sorry, that's an obvious point, but I thought I might tell you. Also, Joost mentioned that he was on here today from Amsterdam. You can get the stock analysis reports in the language of your choice as well. So Joost, tuning in from Amsterdam, part of the world that I love, and I have spent, I've been fortunate to get a significant amount of trips to Amsterdam because we have a wide range of subscribers in the Netherlands. So particularly we have you in mind when we say that we have the Dutch stock analysis report here, or any one of the other languages that are up there. Okay, now, so what happens here is iShares Dow Jones Select Dividend Index Fund seeks investment results that correspond generally to the price and yield performance of the Dow Jones US Select Dividend Index. Now, let me explain the way this works. If I was to go on to the Dow Jones ETF, I would be looking at an ETF that tracks the value of the Dow. And for those of you who are familiar with the Dow as opposed to the S&P, the Dow is a price-weighted index. The larger the price of the stock, the larger the weight it has on the Dow, which is different to the S&P. However, the thing is that this type of an ETF, this type of an ETF, E exchange, T traded, F fund, a fund that tracks an index on an exchange, this is going to instead not weight the stocks by the price, but by the dividend. Okay, so let's just go and take a look at that. So what I'm going to do is let's just pop over to the iShares website, iShares.com. Okay. I'm just going to go in here into DVY. Let's go in here. Let's go to the US page and let me search our funds, view all funds, and in here now we'll just take a look for DVY. Okay, DVY. There we are. Okay, fact sheet. My document is loading. I know I'm always interested in that. It says click here to explain. Okay, let's zoom right in there now. Okay, everyone can see that? Great. So what's here is that this is the fact sheet as of the 30th of August. So they haven't moved into October yet. But that's okay. It's generally updated now. That's been expanded a little bit too much. Okay. So you can see here exposure to broad cap US companies with a consistent history of dividends. Access 100 US stocks with 5-year records of paying dividends, and use to seek income. So these ETFs are typically for individuals who are interested in looking out for dividends. So as you can see here, the fund began in 2003. The expense ratio is 0.39%. That means for every $100 invested, 39 cents would be paid in fees to the fund manager that runs this. Now look at that, the yield here. Now, Monica, back to you again. The yield here is 4.72%, but that's based on the yield at the end of September. And of course, price may have changed since then, as well as the dividends themselves. Okay, number of holdings, 100. Don't think anybody's surprised at that, since it says access to 100 stocks over here. The net assets are $12 billion, okay? Now, we have the ticker code here of DVY, and these are the companies. Altria, Prudential, International Paper, Philip Morris, Wells Fargo, AT&T, a lot of those names there I'm sure many of you will be familiar with. And the top 10 holdings make up 19.32%. Now, often people are surprised when I tell them this figure, but if I went back 100 years, round about that. In fact, we could go back to 1895 when Colgate started paying dividends. If I went back 100 years and I was to say to you, what return on average has the stock market delivered over that period of time on average every year, including years that was the pits like 2008, or in years that it rocketed like 2009, as well as years when it didn't do a whole lot except be volatile like 2011. Over that 100 years, 120 years, what's the average return? And the answer is 8 to 10% compound per annum. So you see that actually what this has done is it has delivered, on average when you look at the past 10 years, it has pretty much delivered the average return over the past 10 years. Interesting as well here to see what happened in that period, which was of course the same precipitous fall that we all had to watch, and well, some of us suffered through it, some of us fortunately got out and got in again at the right time. But this over here is an example of when the fund, well, it's not just an example, it's the whole history of the fund there is in money terms, so you can see how that fared out. Then you can see down here, a good way to analyse an ETF is how it's diversified across its sectors. And also down here, its standard deviation, that's a measure of volatility. You can see its PE ratio, very low, 10.85. And then, as I say, you can see the 0.39%. So what are the key things that I watch out for when analysing an ETF? Number one is I look at when did it launch. Anything that's too early, I kind of like, or, very, very recent, that's what I mean, is I kind of like a bit of history behind it so that I can see how it's going. I look at the expense ratio naturally. The expense ratio is the fees involved in investing in the fund. The third thing I look at is the yield. Even if I'm not investing in a fund just for its dividend, I always look for the yield. Number of holdings, I look at the net assets, and then I look at how concentrated are the top holdings. So as you can see here, we've 10 top holdings that make up 19.32%. I've seen ETFs where the top 10 holdings could be 50% of the ETF, and that's not a very diverse pool. If that's the reason you're buying the ETF. Then over here, I always look at the performance, and I kind of look at more so the longer, the longer term. It's not always common to see a 10-year record of an ETF. Like the first ETF actually was only issued in 1993, and it was the S&P 500, one that tracks the S&P 500 called SPY. And their annualized figures, sorry, I should have mentioned that they're annualized figures. Then I always look at the sector, and I look at things like the PE ratio and the volatility. And well, that's the fees, we've already mentioned those. So that's how you do it. That is how you can analyze them. And of course, if we bring it back in here, then I can always use the VectorVest statistics then as well, and the proprietary indicators in here. And there's, I'll come back to Dollar General again. So anyway, it's the same figures in there. That is what we would look at. We'd look at, again, the dividend safety. We'd look at the RT and all of those things that I would love to tell you all about. And I will over various different episodes of the show in the coming weeks and months. I had a meeting last week with the production team, and with some really interesting episodes coming up. On that note, could I'd really appreciate if you wouldn't mind, could you please like this particular video? It's always good. It's always good to see if people like the content. So if you would please just push the like button and let us know if you're enjoying the content. That is, of course, always important to us. Now, what I'm going to do is I just want to do. Let me just make sure now that you can see what I can see. Oh yeah, very good. So what I'm just going to do here now is just bring you through the last of the slides here, which is, remember what we particularly spoke about today, which is what do you need to see in what you need to look for in a dividend. You need to look for dividend yield, dividend safety, and also dividend growth. All three matter. Okay, and it's if you find a really high dividend yield, but on the other hand, actually it's not very safe and it's unlikely to grow, that's probably not going to be what you're going to look for. Similarly, you can find a high yield and a high previous growth rate, but it's not very safe. Well then, is that really where you want to be? And then similarly, you can find a high dividend yield and then it has very good safety, but you probably want a growing dividend. So putting the three together is a really good idea. So that brings us to the end of this episode of Fantastic Female Fridays, where we discussed basic dividend concepts. We discussed why dividends matter, where do I find the dividend information, and what do I need to look for in a dividend, as well as how do I analyse dividend-focused ETFs. And that is where I have delivered upon what I promised for you today. And let me just take a look there now in the chat, see if anybody has any questions. Great stuff. Okay. Ninja says, thanks for the insight, delighted, more than welcome. Charles says, very informative class as usual. Thank you, Charles, I appreciate that a lot. And that's the point, that's always the point of Fantastic Female Fridays. It's to build your knowledge and build your confidence with the tools that are out there. Yes, of course, I will be telling you about the VectorVest program, but also I will tell you about lots of resources that are available. And for those of you who may be new to the system, or where you may not have access to the system, I will show you how to find what you need to find. So at least you can get some insight, like the free stock analysis report. Oh, Monica, this is your first Fantastic Female Fridays. All right. Okay. Oh, you're very, very welcome. I didn't realise that. Yes, delighted to hear that. And we have lots of other episodes as well. We should be having like the Fantastic Female Fridays box set really coming out at some stage. I'm only joking, Monica. They're all there anyway. So I'm really delighted that you've been here. And also, of course, you're super welcome. Super, super welcome. We'll be back again 2 weeks' time. Yoga said, like, very much. Delighted to hear that. Betsy says, thank you, Susan. Always get a lot out of your programs. I'm delighted to hear that, Betsy. It means a lot. Thank you. And we have, as I say, lots more coming along the way. Sandy says, great review of dividends. Thanks. You're welcome, Sandy. You're absolutely welcome indeed. And we have a lot more to come. Thanks, VectorVest, for that shout out. And I really appreciate you being here with me as well to take care of everything today. Then Monica said, I'll take a look. Great stuff. Thank you. And then Niranyana Girl says, great info. Delighted to hear it. Again, just want to say thanks so much indeed to my research assistant this week, to Hayley. Also to say thanks a million to Clay and Joy for their Clay and I, as I say, we had a meeting this week about the episodes to come, and Joy is just the most amazing guy when it comes to production. He is so super reliable and super knowledgeable, and it's wonderful to work with him. JD says, did the same chat, but you did it so much better. Thank you. Thank you very much. And Robert says, is there a replay for VectorVest users? Certainly, this link will be here and it will remain here as well. So, by the way, also, for anybody who's watching this but isn't watching it live and you have a comment, pop it in, and one of us will be there so we can give you any details you want. Maybe you need the link to the free stock analysis again, or you might be looking for something. Michael says thank you so much. You're very, very welcome, Michael, and I really do appreciate it to each and every one of you. So on that note, I'm going to see you in 2 weeks' time, Friday the 20th of November. And next time what we're going to talk about is how to talk to your partner about money. So we're going to, yes, I'm going to get right at those heartstrings. And when it comes to shaping an investment portfolio or understanding your own investment personality, of course, when you are talking to your partner about this, two of you may be bringing two very different sides of the story. And I'm going to give you some ways in which to make sure that conversation is smooth, and but also some really good questions to ask of yourself and of each other, so that then you can, and as well as that, I also want to share some, I have to say personally speaking, some things that I do with my own partner and husband. He and I have certain ways that we pick stocks together, and we have a communication process around it and so on. Sorry, not a communication process. Let's not go that type of corporate speak about it, but certainly just things that have certainly worked that I want to share from my point of view. And of course, as always, you're always super welcome to interact like we've been doing today. So that is, of course, what it's going to be all about. Thanks a million to the guys at VectorVest. They put up the link there again. The free stock analysis report is, as the name suggests, it's free. You can use 3 on any one given day and 9 overall. So use them whatever way you want. JD says, amazing, more training from you, please. Lots more to come, JD, promise. So on that note, guys, have a lovely Friday. Thank you so much indeed for tuning in today. Really appreciate your time, and I'm going to see you all in 2 weeks. Thanks a million. Bye.